The Chinese central bank acts again, cuts both lending and deposit rates by 25 basis points in a bid to boost the ailing economy, which in turn fuels a rally across all global markets.
The clamour for a rate cut back home in India only grows louder, with the government saying it's the perfect time to cut rates. This even as the latest minutes of the RBI Advisory Committee shows the RBI governor ignored the majority view, suggesting a rate cut in July.
It's a spectacular recovery for the Indian markets, with the Sensex gaining more than 500 points from the day's low. The Nifty gains close to 1% to end above 7,850.
Some respite for emerging market currencies, with the dollar losing ground. The rupee rallies 0.7% as a turnaround in equities boosts sentiment. The currency closed at 66.1 today.
We will pass it at the earliest opportunity, at the first occasion of the House. That is the assurance given on the floor of the House. So, keeping that in mind, this is called as walking an extra mile. This is called as give-and-take approach. This is called as accommodating the opposition.
The government makes a fresh attempt to try and convene a special session of Parliament in order to pass crucial legislations like the GST bill, even as the fate of the land ordinance hangs in limbo.
The land ordinance may be re-promulgated for a record fourth time. Parliamentary Affairs Minister Venkaiah Naidu defends the move, saying 13 other acts would be adversely affected if the ordinance is allowed to lapse on the 31st of August.
The Union Home Minister meets the Defence Minister and PMO officials as the government tries to firm up its view on the one rank, one pension scheme. An announcement is likely to be made on the 28th of August, the 50th anniversary of the 1965 Indo-Pak War.
Swedish furniture giant IKEA has big plans for India. The company's spokesperson tells CNBC TV 18 it will be opening 25 stores across 4 cities in the country. That's an exclusive.
I would be very surprised if they did raise in September. I think it's much more likely that they would raise in December than in September.
There goes the opening bell, and it's opened with a 1.2% uptick on the Nifty, and the Bank Nifty is the one that's shouldering most of the burden, up about 1.5%.
These are actually turbulent times. But one thing I think, and I can answer straight away, is these are not levels to set, not particularly in India.
India has more or less rebalanced its economy. The rest of the emerging world, and I think this is primarily an EM problem that we're dealing with, not a DM problem as much, is actually facing a lot of problems.
Market recovery today is not going to signal the end of the turbulence. We should be prepared for potential disruptions both in financial markets and in product markets for some time to come.
The market recovery was quite sharp. I'm talking about the midday when we had that 1:4 advance decline. Stock of the day probably was Amara Raja batteries. They were bigger winners, but in terms of the kind of price move, volume move, and the fact that the stock is back to previous highs.
Well, what a difference 24 hours can make. It's a spectacular recovery for the Indian equity markets, which came off their early morning jitters to post some smart gains by the end of the day. In fact, the Indian markets outshining their Asian peers. Good evening. It is finally a good evening today. Thanks very much for joining us on India Business Hour. Hi, Nantara.
June, you're wearing the color of the day. This is the color we're seeing on most trading screens at the moment.
Maybe I brought good luck to the markets. What can I say? But we'll get to all of that in a bit. But the Chinese central bank has done its part. It's also walked the line by cutting interest rates for the 5th straight time since November, especially on a day when the Chinese markets lost yet another 7% in trade. But the PBOC's move undoubtedly lifted sentiments across Europe and the US. But before we get you those details, here's a look at the market action back home, where we did see a turnaround. A recovery that we saw in the markets today, with the Indian equities clearly outshining Asian peers, ending the day with smart gains. but not without their share of hiccups and volatility. In fact, the turbulence lasted pretty much through the day. The Sensex shaved off nearly 450 points after opening on a positive note. It was a similar story for the Nifty, which also hit a one-year low, only to stage a spectacular recovery in the second half of trade. And today, the Bank Nifty, that was the one that moved higher, ably supported by the mid-cap index, which led the recovery today. We'll get you a detailed wrap of the trading action with Anuj and Sonia. That's coming up for you in just a bit. But the big international story that has global markets excited. China's central bank has cut interest rates in response to the market turbulence. It's cut the main interest rate by 0.25 percentage points to 4.6%. This after 2 days of stock market turmoil. But experts that we've been speaking to through the day today say that the move is not significant, but the timing is significant given the events of the recent days. Now, the PBOC has also cut the one-year deposit rate to 1.75%. It's lowered the reserve requirement ratio, which governs how much money banks can lend to the economy. The central bank has said that the interest rate cut was to reduce the social cost of financing to promote and support the sustainable and healthy development of the real economy. Whether or not that happens is a separate matter altogether, but at this point in time, the opinion seems to be reflected on screens across global markets, US, Europe, and of course our markets had already shut for the day, but the US and the European markets giving China a big thumbs up. So how are economists and policymakers reading China's fifth rate cut since November? Listen in.
It is conventional economic policy to support what is a slowing economy. I don't think it should be viewed as something to support the stock market generally. As I say, it's conventional economic policy. Our argument at UBS has been for some time that they need to keep cutting interest rates to simply maintain real interest rates fairly stable or for them to fall, because inflation has fallen so much this year. We do think there's things to buy. We have a report out overnight where we highlight some pockets of interest, I think, out there. India, certainly, which remains a very good story in emerging markets.
The obviously problematic situation in China and its scale relative to the global economy, particularly global commodity markets. Add to that the more generalized distress that seems to exist in many emerging markets. Layer on that the fact that the underlying rate of demand growth in the major industrialized countries, Japan, Europe, the United States, has not been what people expected. I think it's very hard in the midst of the current financial turmoil to imagine the prudence of a rate increase.
I think we go the way that China goes, because if we think about the pullback that we had this last couple of days, it's all been made in China. This is not about U.S. weakness. This is entirely about whether China is going to slow or not. So today, the breaking news that you had this morning is the fact that China cut interest rates and is going to add liquidity into the market. That's significant. So I think that's the catalyst for the bounce back.
I'm convinced that China will do everything possible to stabilize its economic situation. China is an important partner to the European Union, and we are in close contact with them.
We need to work on international financial architecture to protect our banking systems from these kinds of global issues. And I'm reasonably confident, although I don't think we can be unaffected by what happens in China. I don't think it's going to cause immediate sharp problems in Europe.
I'm sure that China will find the right response to overcome its economic difficulties, which every economy has to face from time to time.
The world was being shouldered by a powerful engine. That engine doesn't seem to be now running as fast, and therefore the world will require alternate engines. That's one way of looking at it. The commodity markets are badly affected, oil, other commodities. And we are a net importer, so we'll get our commodities cheaper. We are not net exporters of commodities. So we are theoretically the least to be anticipated. So can we convert this into an opportunity? Now, can we, wherever we are lacking in further reforms, can we just speed them up? Expedite our own expenditure, and if the world sees that we are the only one growing in the 7-8% range and everybody else is far below, so you may be able to attract more people in the world.
If it stimulates the economy, then good. because China is considered as one of the growth engines of the world. So to that extent, if it stimulates the Chinese economy, it should be good. And whether it will have a direct impact on India, we have to wait to see.
There you go, the world's top political leaders, bankers, analysts, all of them reacting to all the developments unfolding in China. Forget the US Fed, we're not looking at triggers. All of them coming out of China, and the Chinese central bank's decision to cut rates were lapped up by the global equity markets. The US markets, let's talk about that first. They opened with sharp gains, writing off most of the losses that had been posted yesterday. In fact, all the 10 sectors in the S&P currently trading in the green, while all the 30 Dow stocks are currently headed higher. So look at the Dow, that's up 370 points, the Nasdaq up almost 150 points, S&P 500 up by about 2.5%. And guess what? It's a similar story playing out across the Atlantic, where the European stock markets are pushing higher as well. Black Monday turning into turnaround Tuesday. The German DAX, that's up by 480 points. The French CAC up by 181 points. The British FTSE also having a great day in trade, up by almost 3% or 182 points.
Well, look at the markets and look at the rally that we're seeing across global markets. Look at the DAX, it's higher by about 5% today. What a difference we're seeing between how the markets were trading yesterday and what we're seeing on the screen today across global equity markets. But back home, on the back of what's coming from the Chinese central bank, the clamour is growing for the Reserve Bank of India to also cut rates. But take a look at what's happened. The Technical Advisory Committee's report, which was released today, shows that the Reserve Bank Governor Raghuram Rajan went against the majority decision in the July policy when he maintained a status quo on rates. Ritu joins us now with more details. Ritu, this is not the first time. In fact, this is the 5th time that the Reserve Bank Governor has utilized the veto power and gone against the majority opinion to keep rates as is.
In fact, not the first time. The clamour for rate cuts has been growing louder for quite some time now, and Rajan has this time yet again gone against all that pressure and the majority view of the Technical Advisory Committee and decided not to cut rates in the last policy in August. In fact, 7 out of these 7 members in the Technical Advisory Committee, 4 were for RBI cutting rates in the last policy. In fact, 3 of them said RBI must cut rates by 25 basis points, and 1 member went on to say that RBI should lower rates by about 50 basis points. And the main reasons, the arguments they put forth were as follows. 1, demand in the country remained very low and therefore needed the support of softer prices. 2, inflation levels were far below the RBI's comfort level, and therefore there was headroom for the RBI really to bring down rates right now. 3rd, they must make use of the window of opportunity they have before the Fed decides to hike rates. And 4thly, and most importantly, the fiscal deficits and the current account deficit both are in a good condition right now, and therefore there is room and opportunity for RBI to act now instead of later. But 3 of those 7 members held a different view. In fact, they argued that liquidity in the system is in excess right now, and what the RBI should be doing is really draining that out. And more importantly, the outcome of the monsoons was still uncertain, and therefore its impact on inflation was something that the RBI must have to wait and watch out for, and therefore it shouldn't act in a haste and should remain and continue to monitor data before it acted on the policy rates. And that's exactly what the governor chose to do. In fact, he said any further rate cuts from now on will all be data dependent.
Thanks, Aditya, for joining us. With that, of course, we'll have to watch out and see if there's going to be an out-of-turn policy cut or not. It's something the government has been asking for repeatedly, especially after the IIP and the CPI data had come around last time round. We understand North Block had spoken with the governor asking for that out-of-turn rate cut. But like Ritu was pointing out, it's going to be data-dependent. And like Shireen promised, Anuj Singhal and Sonia Shenoy are joining us to wrap up today's trading action. Anuj, Sonia, the Indian markets finally back in the green after 3 days. Of course, that's part of the global story.
Yeah, it looked like, our market was sensing a bit of what could happen from China, and, we're seeing the kind of impact on global markets, but it was a significant recovery for our market, Sonia. In fact, the Nifty recovered 200 points from intraday lows. It had a good start. After that, there was a big slide. It looked like the market was testing lower levels. It looked like panic was back on the street, and then came the late recovery, 200-point intraday recovery, led by banks. Banks, of course, led the short covering move intraday's trade, but there were big gains in high beta names as well, the likes of real estate. The volatility index today plunged 32%, and that's after the kind of surge that we had seen. That 32% is intraday. From the high point of the day, the volatility index came down quite a bit in today's trade. The only worry for this market was that the cash market volumes were very high, and the feedback we got was that this market rally was essentially driven by domestic flows, and the FII money still remains on the sideline or still remains on the sell side. So that's still a bit of a worry for the market. Global factors, of course, are still at play, and it looks like global markets have still not stabilized. The kind of moves that you're seeing, 4%, 5% for developed markets, these are not normal moves, either on the upside or on the downside. And what the markets would now need is a bit of a stability in some of these markets. A few boring days, maybe, in terms of the CAC, the DAX, the Dow Jones, that is, and see how things go from here. And for our markets, keep in mind, the market will have to deal with expiry issues as well over the last couple of days. But with this China move, you do get a sense that some more short covering bounce is expected, and maybe the Nifty has a date with 8,000 tomorrow. And after that, of course, it's all about whether incremental money supports market or not. But today was quite volatile, and a lot of stocks reflected that volatility.
Oh yes, it did. And you know what? Our markets sometimes have the uncanny knack of preempting global cues, whether positive or negative. And I think we did preempt the China rate cut. So perhaps some of that was already priced in. But there was a big recovery in banks today. So that was the big pocket of strength. Yes Bank up 8%, ICICI Bank up 5%, Axis Bank up 5%, and SBI was up about 3% odd. But not just that, you had other heavyweights that rose as well. So you had Tata Motors that staged a smart comeback, up about 7% odd, Reliance up 3%, and Coal India was up 5%. All of this could jolly well be just short covering, but there was a conclusive move on the upside. The metals pocket did well. Vedanta and Tata Steel were both up about 4.5% to 6.5% odd. But on the losing end, one sector that stood out was technology. So HCL Tech, Infosys, Wipro and TCS were all in the red today, as you can see, anywhere between 0.5% to 1.5% odd. The power stocks too saw some losses. So you had Power Grid, Tata Power that were both in the red today. But let's take a look at the mid caps, because there the move was a little more interesting. You had a lot of the quality names surge in trade today. So Amara Raja Batteries hit a fresh record high. SRF, Dish TV, PI Industries, and all of these are big bull market movers. So they've staged a comeback today. IFCI too moved quite well. We also saw some pockets that saw short covering. So real estate did well. India Bulls Real Estate, DLF and HDIL were also quite strong in trade. All right, Sonia Anuj, thanks very much for wrapping up the market action. Let's see if the markets hold tomorrow, move higher, or finally give up the gains that we saw today. But India and most global equity markets have dug in their heels after Monday's worldwide drought. Experts say there could be further downside globally. However, most of them believe that India is relatively better positioned in the emerging market basket. Take a look.
Markets in China and Japan continue to take it on the chin. But most Asian and European markets are beginning to shake off the impact of the body blow they suffered on Monday. However, some experts believe a full-blown recovery will not be quick or easy, especially given continuing uncertainty around China.
I think the emerging markets in general are still going to have a very tough time. And I would say you could see maybe another 10 to 15% fall in the emerging market as an overall category before things sort of bottom out.
Emerging markets I am selling. I have been selling for some time, and I don't think there's any reason to buy today. There's been some sense of capitulation, or at least some folks have been speaking about a capitulation in emerging markets, and I don't think there is.
Others, however, feel that the Chinese government may have been unnecessarily preemptive with its reactions that have triggered this crash, and believe cooler heads will prevail soon enough.
When the market in China first cracked, the government overreacted. First they raised the margin requirements, then they cut them, then they issued a whole string of things, banning selling, banning short selling, making insiders buy back shares they had sold, doing all kinds of things.
But whether this happens tomorrow or a few weeks down the line, India continues to be a strong favorite for riding out the storm.
Our target for the index was around 8,000, and obviously we kind of overshot that, which we always do. It's not 2008, that's for sure, because it's not the banking system. This is just China slowing down.
One should focus on the local fundamentals, because that is what is a driver of markets medium to long term. The Indian economy is on the path to recovery. Our current account is in very good shape.
We've had a couple of falling tops and falling bottoms. So you could call this as a correction which is now 6 or 7 months old. and has produced sizable price retraction as well. So to me, it still seems like a bull market correction. I think it's too early for us to say this is the start of a bear market.
Caution, however, remains the order of the day, especially given global uncertainties other than China.
I think India is very well placed, but it is a question of flows. So if global flows are negative, especially as oil sovereigns from different countries are having challenges on their domestic deficits, so we have to watch the global flows.
Market recovery today is not going to signal the end of the turbulence. We should be prepared for potential disruptions both in financial markets and in product markets for some time to come.
So for now, all eyes are on China and how its government responds going forward. And in India, of course, expiry is around the corner, which will bring with it some inherent volatility. But over the long term, the Indian markets are expected to hold steady, if not stand tall. In Mumbai, with Sonia Shenoy, Arundhati Ramanan.
Well, joining us now on India Business Hour to make sense of what we're seeing in our markets and how they're likely to react to global cues is the Joint Managing Director, Motilal Oswal, Ramdev Agarwal. Ramdev, appreciate you joining us here. Speaking first about yesterday's fall, when we saw the 1,600-point drop on the Sensex, there was clearly panic on the street. It's been a role reversal for the FIIs, with the FIIs selling out specifically yesterday, and domestic investors, in fact, buying yesterday. What do you make of that kind of divergence, and what are you now sensing from your clients? Is there panic at this point?
This is the largest fall I have ever seen, and yet there was no panic on the ground. I mean, at least among our retail clients and HNIs, I don't see any panic whatsoever. In fact, we had the largest flow yesterday and even bigger today. So clearly people are not scared and running away from the market. They're actually saying that this is a great opportunity to buy, and somehow they are piling on, and so much so that yesterday we couldn't stamp some of the applications. So clearly there is no panic among the minds of the investors, but this is the largest fall per se. There is a fundamental difference right now as far as the behavior of the investor is concerned. Second thing is that so far for last 3-4 years, FIs were buying, domestics were selling. Now FIs are selling and domestics are buying. So in that situation, of course, when there is a one set of, and both of them are pretty big. I mean, now FIs are 20-22% of the floating stock, and probably retail and domestics are 16-17%, almost same size. So they can take care of each other, and this bout of buying, selling, and of course FIs have far more determined, far deeper pockets, and they are present in all the blue chips. So clearly it will make a difference. I don't think index can move significantly upward if FIs remain bearish on India.
Absolutely, but Ramdev, you said that clients are seeing this as a buying opportunity, and you've been flooded with calls over the last 48 hours. But where do you really see value at this point in time? And specifically, as far as the mid-caps are concerned, the kind of fall that we saw in the mid-cap index yesterday, 9% being shaved off that index, would you hazard moving into any mid-caps at this point in time, or would you stick with the blue chips?
The first thing is we stick with the blue chips. The quality and growth, that's our theme. So clearly we'll stick to that. And just one day's 5-7% fall doesn't change the portfolio construct. I mean, we buy mid cap, we buy large cap, wherever there is a quality and growth, we'll buy. So clearly stocks are 5-10% cheaper. So the people who are coming now, they are getting a much better bargain. So I would think that shorter term return expectations should be muted, and probably it can have, maybe a few percentage point fall for some time, and maybe, but I think 12 to 18 months outlook is actually becoming better because the base is lower, clearly 10% lower.
Okay.
So you're buying cheaper, and outlook, because the best of India is ahead. We are growth story is still building up. Your interest rate, of course, decline. I mean, governor was not very kind to throw few bits like Chinese governor is throwing rate cuts on every fall.
Do you believe now the pressure is mounting on Raghuram Rajan to cut interest rates, Ramdev?
No, but he has said very clearly he is not obliged to please the stock markets and the commentators on the TV to give rate cuts. He is going to give rate cuts when he thinks it is right for the economy in the long run to give the rate cuts. So I would think that we are in the safe hands, and he knows what is to be done in this thing. So don't count on him for the short-term goodies. And keeping that in mind, I think we have to stick to the companies and the portfolios, more than companies, the portfolios, which has a quality which will allow us not to, yes, we'll go down, but will not allow us to, it's like a floater. Quality is like a floater, and it will go down for sure for some time, but it will come back. And growth will take care of from going from one destination to other destination.
Given the way that we've actually seen the rupee depreciate and the kind of volatility that we're seeing in the currency market as well, what looks most attractive to you at this point in time, Ramdev, from a sectoral point of view?
See, I think you have to, in this kind of situation, I don't think there is one set strategy. I think you have to go back to your investment philosophy, and any company from any sector fits into that kind of a strategy, go ahead and have in the portfolio. Because to say this is right or this is wrong, because it's a really volatile kind of world. I mean, something which was right till yesterday is wrong today. So, and the government, regulators are quite active, currency markets are active, like at some point of time currency was bad for some of the companies. Today currency is the biggest strength for that company. So, you know, in this changing environment, I would not stick to say, I mean, broadly consumer, pharma, IT, I mean, the conventional names, good companies, they will do well. But you can get a lot of opportunities which are which will come up, and a lot of stocks in your portfolio which will get destroyed overnight.
Well, that's Ramdev Agrawal sounding quite confident about the equity markets, at least in the medium to the long term. We're done with the equity markets. Now let's talk about Mint Street. It's been a spectacular recovery for the Indian currency as well, with the rupee posting the biggest intraday gain since March of 2014. Lata Venkatesh are standing by with the details. Lata, what do you think helped the rupee claw back to the kind of levels we saw today?
Oh, absolutely. The rupee was falling because of the savage fall we saw across all risk assets, especially emerging market equities and currencies. But you will have to say, to the credit of the Indian currency, that it fell the least. It was an outperformer even in falling markets. So the reversal also had to come faster and sharper. As it is in early morning trades, the dollar had become as expensive as about 66.76. That is when the Indian markets had fallen by about 300, 400 points. But as the reversal came in the equity markets, the rupee was to reverse much faster. To be sure, it was helped by some dollar selling by the Reserve Bank, but thereafter it picked momentum on its own, with a lot of people wanting to cover their rupee shorts or at least unwind their dollar longs as the dollar started falling even against other emerging market currencies, and ended the day about 66.10. The rupee had by then already been aware of the fact that the Chinese PBOC had moved to cut rates, and therefore that news has gotten factored in. But nevertheless, traders tell us that there are so many long dollar positions which people don't want to be, certainly not against the rupee, because the rupee is seen as a fundamentally appreciating currency, that chances are tomorrow it's going to settle at 65.75 pretty quickly and then take its direction from the equity markets.
Thanks, Lata, for joining us with that analysis. This is the best intraday gain for the rupee since March of last year. And one person who's confident the rupee will continue to make some smart gains is the chairman of Godrej and Boyce, Jamshed Godrej. Listen in.
It may not be that that the rupee stays at this level for a significant period of time. It's more than likely that it will come back, and find its own level very soon.
Well, who knows where the rupee is going to be tomorrow. At this point in time, it bodes well for the global equity markets, which means our markets could be poised to start higher as well. And they're on the back of the action that we've seen coming from the Chinese Central Bank, which also means that it could be more positive news for the currency market. But we'll be tracking all the action right here. We'll tell you how the US markets close, and we'll tell you how the Asian markets open. So stay tuned to CNBC TV 18.